Can you explain just how large Reliance has become today?
First company in India to cross 10 lakh crore in revenue. Market cap of 16.4 trillion rupees. Among the 100 largest companies in the world. It alone pays more than 3.5% of the overall corporate tax in the country. 28% of India's gas production, 50% of India's telecom subscribers.
And don't forget the mango exports. That's frankly, the speed at which they move is simply unmatched, and unmatched because it's probably hard to match it.
They always thought in terms of creating world scale. It has taken probably 30 years for people to catch up. It's not like they have not had failures. They did a very ambitious set of acquisitions in the US shale. Didn't work. They had to write off around $7 billion plus. They have at any point of time, I think more than 1 lakh, 1,20,000, 1,30,000 crore of cash in hand.
In this episode of The Spotlight, we're going to discuss India's largest listed company, Reliance Industries. To do this, I have Probal Sen of ICICI Securities, who's going to explain the evolution of the company into what it is today. We discuss a lot of aspects of the business and dive deep into the economics of the business, focusing specifically on the engine that has driven a lot of the growth, which is the O2C or oils to chemical business. I hope you find the conversation useful. Thanks for watching. So let's set the scene to begin with. Can you explain just how large Reliance has become today?
Just to put a few numbers, obviously, to get the perspective. It's the first company in India to cross 10 lakh crore in revenue. Market cap of 16.4 trillion rupees, which is obviously, it's probably among the 100 largest companies in the world. By far, obviously, it's the largest company in India. More importantly, if you look at the contribution to the government, which also puts its importance in terms of the Indian economy in perspective, it alone pays more than 3.5% of the overall corporate tax in the country. If I look at last year's payment, it was somewhere around 26,000 crores, which is more than 3% of India's direct corporate tax.
Right.
And if I look at the overall payments of duties, profit petroleum, the indirect taxes, 1.86 lakh crores is the amount that it pays to the exchequer, which is, I think, somewhere around 14% of India's total budget. I think 16% of overall merchandise exports comes from this company. 28% of India's gas production, 27% of India's refining capacity, almost 40% effectively of India's petrochemical capacity. You can go on and on, but I think, of course, the 50% of India's telecom subscribers, and if I look at its retail revenue of more than 3 lakh crores, that is about 6 times that of its nearest peer, which is DMart. This is all last year's numbers. Obviously, this year is still going on.
Right.
That's the kind of scale that you have in every business that they've set up in the last 2 decades.
And don't forget the mango exports.
Yes. And now probably, you have the wildlife preserve that he's setting up. God knows what scale he's, Anant Ambani is going to set up that at. So that is Vantara could also become something in the discussion. And they have a financial subsidiary, which is not strictly now part of Reliance Industries,
Right.
JFSL. That also is capitalized without any business at about 2 lakh crores.
Right.
So, that's the scale where they are looking to set up mutual funds and, other financial services. So that itself could become something in the, obviously very material in the Indian context. So it's a massive company, whichever metric you apply in terms of profitability, revenue, contribution to the exchequer. Some numbers are just mind-boggling.
Correct. Absolutely. And so really what I want to focus on in our conversation is understanding what has enabled this kind of scale and growth. And I know it's not a young company, but like you said, the scale even over 40, 50 years is incredible to achieve this kind of scale.
Sure.
So let's dive a little deeper into the flywheel that they have managed to establish. Going back maybe 20, 30, 40 years, from the point where they enter the energy business in a big way, can you talk about how they manage that and what that has led to in terms of spawning additional businesses along the way?
So I think, going back, and obviously this is even before my time. So, there's a lot of, you have to rely on what's written about them more than, what I've seen. I think Dhirubhai, his initial experience in the Gulf in Aden, initially obviously started out. Everybody knows the story. He started out at a petrol pump, but then he did work in one of the large trading houses to the east of Suez. I think it was called the House of Aces, if I'm remembering correctly.
Wasn't that Bessie and Company? Or was that?
Sorry, Bessie and Company.
Yeah,
That's
yeah,
right.
yeah.
My bad. And that sort of then enabled him to sort of look at a trading opportunity when he came back, because the Suez Canal sort of got stopped. I mean, got blocked at that time because of all that was happening in the Middle East. So they all came back, but he had some funds lined up, and he started a spice trading and textile trading company. I think the fundamental, idea that he had, which was probably unique, was that he immediately realized that you have to control the value chain. If you have to basically capture margins at every stage of whatever industry you're into.
Right.
And it's amazing that someone with that background in the early 60s, when he has started just polyester trading, sees an opportunity and looks at basically at that point of time and says, okay, I'm setting up a polyester factory now, but the idea is basically to then backward integrate the whole way, because I don't want to be at the mercy of somebody else when it comes to controlling my raw material cost, my efficiencies across the chain, and I want to capture the margins at every stage of the value chain.
Right.
If you look at how the petrochemical industry works, I think the fundamental difference between what Reliance has done between versus what anybody else has done even till date in India is that nobody really captures the margins at each stage of the value chain. Right from using ethylene, going on to, let's say, manufacturing paraxylene, then producing PTA, and then using PTA then to, of course, produce the polyesters. What happens there in the petrochemical industry is your cycle for each individual subsegment can sometimes move in very, very different directions. What I mean to say is that you can have polymer margins at one place, you can have polyester margins in another place, and you can have raw material pricing moving in a different direction. I think the vertical integration that they did, or the idea that they had when they even started out, that is one particular reason. The second important thing was that they always thought in terms of creating world scale. Relative, of course, to the time that they were in, but I think the ideas, that Dhirubhai had, even when he was starting out, the scale of the ambition that he had, even in the early 70s, was always to create something that was comparable with world-class standards. Not just in terms of the scale of operations, but also in terms of the quality bringing into it, the kind of operational processes that he would set up, and that automatically sort of really elevated them as they went along, because at that point of time, to have an ambition to set up a global scale operation sitting in India, I mean, that was unheard of, really. Third point obviously is that he had an innate charm, from what one understands, and that enabled him to raise money for projects at a scale, again, that was not something that had been seen. If I recall from the reason for actually going public and literally setting up the equity cult in the mid 70s was that bank financing, to the extent that he was looking for to set up his first polyester factory and sort of expanding it, it was just not really easy to raise that kind of money. There were so many controls on capital controls. There were so many restrictions in terms of importing of equipment. The duty structure was, sort of adverse, particularly with respect to PTA, which he was, going to use in his factory, versus DMT, which was sort of the prevalent raw material at that time, which is what the Wadias were using. So there were a whole lot of things, but again, what he did, okay, I'm going to raise equity from people. And to the point, after listing, he had to host his AGMs in football stadiums, right? I mean, these are famous stories that you would have heard. Right. But these all contribute to putting together an organization that was not limited by the constraints of the operating environment. If one can really, summarize in a nutshell, he never sort of let the constraints of the operating environment hold him back. He said, okay, these are the constraints. What can I do? Within the boundaries of what is possible and legal and ethical, what can I do to basically push it a little bit more, get things going, and, get my way in that sense. So I would say those 3 or 4 things probably were the genesis of the thought process that they have. I don't think it's changed much. If you look even over the last 2 decades in every business they enter.
I want to double click on something you said, which I think is really interesting, which is The key difference being that they control more of the value chain than the competitors. Are there specific data points that we can look at that show the value that has accrued as a result of controlling more of the value chain versus competitors?
So let me put it this way. We refer to something called an integrated margin in the petrochemical segment. What that integrated margin means is starting from the basic raw material or basic input, which could be ethane. In Reliance's case, for example, today they manufacture petrochemicals using three methods. One is the naphtha produced from their refining process. That is one input. Naphtha can be used obviously to make ethane and then onto ethylene. Then they import ethane directly from the US, and then they have something called a refinery off-gas cracker, which is the ROGC that they set up a few years ago.
Sorry, I'm just going to stop you.
Sorry.
Can you explain what cracking is?
Okay. Cracking is essentially the process of breaking down, a basic molecule like an ethane or a propane or a butane into basically something, sort of cracking it. It's a hydrocarbon process, right? You basically apply heat, use some catalysts or some chemical process where you can then convert it into ethylene or other chemicals like propylene or butadiene. And that ethylene then can be further processed into what we call HDPE, which is your high density or low density polyethylene, what we in normal nomenclature would call plastics. So that is how the value chain really works. So cracking essentially is the process of conversion, you can say, of a basic input into sort of further raw materials for the petchem chain.
Right. Sorry, please continue.
So what they do essentially then, from starting from that raw material, then you process your further intermediates, which is essentially the likes of PTA, PVC, MEG, and then you basically go on to produce your final products that you and me essentially consume in the form of polyester fibers, in the form of plastics, in the form of direct chemicals for the industrial applications, and so on and so forth. So when we talk about integrated margins, at each stage of this process, as you can imagine, there is obviously a margin being attached to each stage. When you're going from raw materials to intermediate, the intermediate obviously has a spread, because if you were to purchase it from somewhere else, obviously you would have to sort of pay that margin, because that person has spent money converting the input into intermediates, and then of course the intermediates again onto final products. When you are integrated, when you are present in each of these chains, you are capturing that margin at each stage in the final selling price that you're doing. So now imagine the contrast between a player who has to actually purchase that intermediate from somewhere else. He only has the final manufacturing capability. He cannot really control the cost at which he's sort of purchasing that intermediate. That's driven by market forces. Whatever efficiency he has to only sort of put that in place in the final manufacturing. Unlike a Reliance, which can start sort of optimizing the cost directly of the raw material itself. When it did about 4 to 5 years ago, when it entered into this deal to purchase ethane directly, for example, from US, it invested in what are called VLECs, very large ethane carriers. Because ethane is something that has a very large volume to mass ratio, similar to what liquefied natural gas is. So you have to sort of liquefy it and sort of transport it. But when you start doing it at scale, and given that US obviously at that time, if you go back 5-6 years, that was the time US gas production was really taking off. And you could see that they would probably have a surplus coming through in terms of, ethane, and Henry Hub prices were at a low. And they captured that opportunity. They said, okay, we have naphtha that we produce in-house, but can we diversify and have some of our expanded capacity operating or manufacturing it directly from ethane?
Right.
The third stage, they did refinery. A refinery typically does produce a lot of gases as part of the refining process, which are called off-flue gases, technically speaking. And that gas, they figured out a way to actually capture it and then manufacture petrochemicals. So, and that is the benefit you get when you have a complex this large. The Jamnagar refinery, 1.4 million barrels of oil per day of processing capacity at one site. Even today, there is no other complex like it in the world. Right? And that then gives you the opportunity to do all of these things. They set up something called a petcoke gasifier, for example. Petcoke is one of the lower quality products that you manufacture. In a refining process, what you do essentially is, refining is nothing but essentially a distillation process, if you think about it. You put in a barrel of crude and then you basically distill it at different temperatures. And at different temperatures, different quality of hydrocarbons actually come out. At the higher end, which are called the light distillates, which are some of the highest quality in terms of energy content, you would have the likes of LPG, ATF, gasoline. In the middle, you would have something, you would have your diesel and a couple of other products. At the heavier end, essentially is where you would have the residue and some of the lower products like pet coke coming through, or a bitumen that you can sort of manufacture, use for road construction. These products typically actually sell at a discount to crude, in the sense that, for on a per barrel basis, the price that pet coke makes is negative relative to crude prices. Therefore, it makes sense, therefore, to sort of process it or use it in a different way, which is what they did. So these are the sort of things that they keep sort of doing to optimize and squeeze out every last bit of value that they can. The other part of it is, what kind of crudes can you actually process? How dirty, in a sense, or how inferior is the quality of crude you can find? Because inferior quality crude obviously will sell at a lower price compared to your benchmark crude. And why that is important is that final product prices are a function of being measured against a benchmark crude. For example, a gasoline globally, a barrel of gasoline will sell at, this is the benchmark crude, which is typically Brent or a WTI or a Dubai crude, all the major crude blends in the world. And that plus a certain number of dollars a barrel is what your gasoline price. That price you can't do anything about. Even Reliance can't do anything, because that's a globally traded commodity. What you can do is, if my crude cost is actually even a couple of dollars less than this benchmark, that is value I'm capturing.
Yeah.
And therefore, can I have my refinery, in a situation where it can process these kinds of crude, where I have the ability to process crude which are maybe high in sulfur content, which are heavier crude, which need to be heated up, for example, or which need to be cleaned or purified before I can put it in the system. And yet, if I can produce the same quality of product that everybody else is producing, then I capture that value, which is what they did. I mean, just an amazing data point. The refining complex at Jamnagar has till date processed some 216 different kinds of crude from global sources. You can take Valeros of the world, the largest other refineries in the world. Nobody has processed probably more than 50, 60 kinds of varieties of crude. Nobody tries to do that because there is a challenge involved in introducing every new variety of crude into your crude slate. These guys are just insane in terms of the kind of crudes that they're willing to take up and blend into their system and still produce products which are comparable to, because obviously they export a large part of the refined product.
So, Probal, I'm trying to understand this. So, if you and I know the advantages of controlling the entire value chain, I'm sure all the competitors know the advantages.
Right.
So, what is it that has allowed them to do it, but not anyone else? Or more specifically, why do you think the others have chosen not to do it?
So I don't think that others have chosen not to do it. I think one of the things that worked for them was the first mover advantage was clearly a massive deal. Nobody else has really an access to a location as attractive as Jamnagar. If you really look at it, their ability to get more than 4,000 acres or some insane number of amount of land. It's literally the size of a city, the Jamnagar complex. To be able to get a location like that with access to a world-class port, which has access to all the input, and to basically, have the ability to synchronize, processing units of such different kinds, straight from, basically input of crude and all, as I said, blending naphtha, ethane and ROGC, 3 different technologies for manufacturing petrochemicals, all in the same complex. I mean, it's something that, frankly, nobody else has managed to do. I would not say that nobody else has tried to do it. Just to give you an example, ONGC, was trying to set up a petrochemical plant which was going to run on imported LNG and ethane, called Opal, ONGC Petrochemical Additives Limited. And that project, I think, first kicked off, in 2004 or 2005. It got completed with a delay of around 5-7 years. I think in 2000, late 2010s, I think. And then what happened was, because there was so much of cost overrun that happened, the economics just did not work. There have been other refiners like, the OMCs, for example. They have also tried to do it. But what happens in oil marketing companies, for example, when I mentioned about crude sourcing, you can set up the units, but then you have to have the operational flexibility to leverage those units. Now, the oil marketing companies have a tendering process when it comes to procuring crude. Uh, as opposed to, let's say, Reliance, if what happens in the crude industry is you can have stranded cargoes, in the sense that there's a cargo that is sort of set off for a destination.
Okay.
Some problem happened in the contract. That cargo gets stranded.
Okay.
If that crude is actually of a specification that is good and attractive to Reliance, Reliance can actually turn around and basically put an order for that crude and divert it to their ports. And OMC can't do that, because he will have a very set process by which the crude pricing is done, the crude contract is done, and so on and so forth. That is changing. I'm happy to say that the government has worked on giving more autonomy to the OMCs to be more flexible, but for a very long time, nobody other than Reliance was able to do it. Third thing is that you're right that it's a mystery that why nobody else had probably the vision or the ability, whatever magic potion they have in terms of working and being able to do refining all the way through to petrochemical production in one complex. It has taken probably 30 years for people to catch up. HPCL, for example, Hindustan Petroleum, is setting up a state-of-the-art 9 million ton. It's still at a smaller scale than Reliance, but it is setting up a 9 million ton refinery in Vizag, which will be the first of its kind among the OMCs, where it will straight convert 30% of that 9 million ton into petrochemicals at the same site. So that's how far ahead of its time, probably in many ways, you can say Reliance is or was. Right. As I said, the ambition and the aspiration, when you go back to 60s, 70s, even 80s for that matter, to actually have that conception that I will control all parts of the value chain, I don't think that was there. And then by the time 90s came along or 2000 came along, you had a certain setup that you had done. It's very difficult to then introduce and go back. Correct. And say that I have IOCL 60 million tons, 70 million tons of refining capacity, but that is spread over 7 sites. You are a government company. You were asked to set up refineries in the northeast because nobody else will do it. You have landlocked refineries in Punjab because government decided then it was needed.
Correct.
For better or worse, that has a very important strategic value.
Correct.
Right? But Reliance obviously did not have that constraint. It did not need to set up a refinery in place X. It did not need to have capacity. The other thing that's interesting is that when it comes to product yield, what I mean by product yield obviously is how much of gasoline, diesel, ATF, naphtha you will produce from a refinery. Now, for example, you always have a set product slate or a typical nameplate capacity. When you sort of get a refinery certified, you say that, or you have a capacity designed to produce, let's say, X percentage of gasoline, X percentage of diesel, and so on. Right. But within that, again, if you have the sort of flexibility, if you have the ability, you can sort of swing between, let's say, a gasoline and a diesel to the extent of 2 to 3%. Now think about a situation where the demand dynamics dictate that gasoline spreads are very strong, but diesel spreads are weakened. If you have the ability to swing it by about 3% and capture that higher gasoline spread, you would do it. Now here also, Reliance probably can do it better than, let's say, a state-owned company to a certain extent, because the state-owned company's yield is determined by what domestic demand is. Okay. Because the government has a role as a promoter and as a regulator. So, and the hat it wears with respect to OMCs can change depending on the business environment. If the country demands an X amount of diesel to be supplied, it doesn't matter what the spread is. Correct. That amount of diesel will be produced.
You make some important points, right? One is that their competitors have constraints that they simply don't have.
Right.
But two, the bigger takeaway for me from your answer was that it appears that Reliance's execution capability and, frankly, the speed at which they move is simply unmatched, and unmatched because it's probably hard to match it, right? And simply the willingness with which they take on risk, it's very difficult, especially for a government entity, to just say, let's just go ahead, we'll figure it out as we go along, right? That they need to know beforehand what is the real risk they're taking on, because then they have people to answer to.
Absolutely.
I actually want to, again, focus a little more on this specifically, which is the speed and execution capability of Reliance as a company, as a group, as an organization. Using Jamnagar as an example, the Jamnagar refinery as an example, can you talk about that entire process where between putting the first stake in the ground and actually starting operations at the refinery, how long that took, and how does that compare to the typical refinery that most other companies put up?
Sure. So I think, it's remarkable that, even the first refinery, I believe 99 is when it was commissioned. It took about 3 to 4 years from start to finish. There are two complexes, right? You set up your first refinery, and then they set up the second. The first one was around 33 million tons.
Okay.
And then the second one was 29 million tons. Both of them were actually set up in almost a record time. In fact, the second one was probably set up within 36 months, which is unheard of even now. If you look at greenfield refineries that have been set up after that in India, none of them has come up in less than 5 years. I was reading something from one of their service providers, Bechtel, which is one of the leading global sort of third-party, contractors who are used to set up refineries. They were speaking about it in the tone that we've never employed the kind of manpower and the kind of resources. They in fact set up 19 dedicated offices globally to service just this one refinery, which they themselves stated that we've never done it. But that was the kind of intensity that was put in. They had set up an infrastructure the size of a small city in that place just to commission a contract. So I think what Reliance does in terms of working with contractors, its third parties, its consultants, it also demands that kind of, efficiency and expertise. And when they see that from the other side, that is the kind of commitment that is there, I think that sort of then pulls it together. I think there is a lot of autonomy probably, or you can say that there's a lot of attention to detail, right down to the last node when they actually set out to do a project. Jamnagar is an example. If I can digress a bit, look at what they did with telecom. Okay, the first foray was a bit of a hit and miss, but then there was a very different time. Both the brothers, had some issues going forward and so on. But the second foray, they went from nothing in 2015 for 14 to 480 million subscribers in less than a decade. That is just, it defies logic in terms of how fast you can do it. All the while also making data cheaper than probably at anywhere else in the world. So retail, 2006 I think was the official start when they entered the organized retail business. It took them 4 years to reach the first 1,000 stores. Probably a couple of million square feet at that point of time, 2010, 11. Today they are sitting at close to almost 19,000 stores, 79 million square feet. And as I said, their revenue is 6x that of the nearest peer. And you've had the likes of Shoppers and all pretty much on a standstill.
Right.
So I would love to tell you that I know how they do it, but the fact of the matter is that they manage to get that done. They manage to do things on a scale. I'm familiar with a few people that do a little bit of work with them in their real estate and in their properties and all. The kind of timelines they put, the kind of speed at which you're expected to sort of finish stuff with the quality standards not being compromised.
Okay.
Nobody else demands that. Nobody else works on those hours. Nobody works on those timelines or scales. Now, obviously they must have, and they do have, the benefit of incredible amount of people, particularly at the top. The likes of Manoj Modi, the likes of PMS Prasad, people who have been with them from probably the initial stages. Some of them have been there for 2 decades plus. Some have been there for probably since inception. But I think what it tells you is that some of these people are there for a reason. They probably are instrumental in putting it together. It's not just Dhirubhai or Mukesh Ambani who's doing it. Some of the trusted people that are there, his I think brothers' sons, the Nikhil and Hetal Meswani, they were actually instrumental in sort of looking after and completion of the Jamnagar refinery. PMS Prasad was instrumental in setting up their oil and gas business, which did very well, faltered, and is again sort of doing very well now. So it's not like they have not had failures.
Right.
That is, I think, important to remember. Obviously, there have been missteps. But given the approach that they take, I think what happens is that, there are more successes than failures. They did a very, very ambitious set of acquisitions in the US shale space, for example. Didn't work. They had to write off around $7 billion plus.
Yeah.
So, telecom, as I said, was probably one of the famous missteps earlier in their history. But I think on an overall basis, the risk taking that you I think mentioned, I think that is very important. The kind of calls that they take when they got into telecom, I think nobody believed, frankly, that it would reach the scale it did. I mean, I'm a very small person. Obviously, we were very skeptical. But I think even industry experts were scoffing at the kind of ambition that they were talking about at that point of time. They made it work in less than a decade.
Yeah.
Retail, nobody believed you could set up 8 million square feet a year consistently. When everybody else is struggling to do a few thousand square feet in terms of store additions and areas and everything else. They've done it now. They've set up 80 million square feet. In again, probably if I really set aside the first few years, they really started to ramp up post 2010-11. So again, it's been a decade or so. So I think that's the DNA.
And it's world, like you said, right? It's world class. You enter, for example, a mall, you enter the Geo Mall in BKC. It is as good, if not better, than any place you can go anywhere in the world, right? It's absolutely world class. And so I want to understand the economics of specifically the energy business within Reliance.
Right.
If, we leave aside Geo and everything else, just focusing just on the energy business. Can you walk me through the economics of that business? Where is it that they actually really make money within that business? And what kind of, just some headline numbers in terms of margins or return metrics or anything else that's there?
Sure. So just to, again, one of the remarkable things is that refining and petrochemical both are extremely cyclical businesses. You will have 3 to 4 years where margins are extremely high. You will have then 3 to 4 years where margins are low. And, then, and sort of keeps going. Every 3-4 years you have a cycle. If I look at the margin trends in terms of EBITDA margins from this business, they have varied from as low as I think 9-10% in the initial years to as high as 20% plus to probably somewhere around 14 to 15% currently. Within that, I think one key thing that has changed is when they were really ramping up the overall complex. I think petrochemical was an extremely profitable business for a very long period of time. What has changed? I think petrochemical probably was making 20+% margins. And therefore, the ROC of the business was also, I think, well ahead of 20-25% for the overall oil to chemicals business, if you want to sort of club it together. What has changed, unfortunately, in the last 3-4 years is the petrochemical business is probably seeing the most prolonged period of cyclical weakness that we have seen in the last 2 decades. It's a function of several factors. One is China, Middle East sort of saw capacity expansions, the likes of which we had not seen for a very long time. Post-pandemic demand pickup, specifically for petrochemicals. Because when you talk about petrochemical demand is very closely tied into demand from real estate, demand from the consuming sectors. Because even a toothpaste tube that you use obviously is a function of the petrochemical that is being produced, because that is derived from petchem. Materials that you're using in the building industry, for example, in furnitures, in finishing, everything sort of has a plastic element to it. So if you think about what has happened in China in the last 3-4 years, the way that their real estate sector has slowed down, plus the kind of excess capacity that was anyways being added, that has had a spillover effect on petchem margins. So if you look at the overall margins, and one has to sort of make a clarification, since FY21, middle of 21, they stopped reporting data for their refining and petchem business separately.
Okay.
They clubbed it together into something what they call the oil to chemical segment. I mean, we try and sort of estimate based on previous data and our experience in terms of what they're doing. But on an overall basis, the OTC business margins have obviously seen a downturn to about 13-14%. ROEs and ROCs would probably still be among the highest in the industry. Because again, it goes back to the fact that they set up a bulk of their infrastructure, probably 40 years ago or 30 years ago. And costs for everything obviously have escalated extremely high. They have had capacity expansions that they've done over 2014, 15, 16, 17. They doubled their PX capacity. They almost doubled their PTA capacity. They set up, additional, the ROGC that I spoke about, the petcoke gasifier. But on an overall basis, this is still by far the highest ROE, ROC generating business. If you look at their consolidated ROE, which is probably still somewhere around 7-8% today, because of all the capex that's happened in retail and Geo, one would expect that the OTC business probably still makes 20% plus returns.
And obviously that business has to generate a meaningful amount of free cash, because in order to spawn these other businesses, the cash had to come from somewhere.
Sure.
So what kind of cash flow, what are the kind of cash flows that come out of that O2C, oils to chemical,
OTC, all to chemical, yeah.
oil to chemical business? What kind of cash flows does that see? And the real question that comes out of that is, what exactly has enabled them to spawn these other businesses that have come along the way?
So two things. Yes, the oil to chemical business accounts for more than 40 to 45% of the EBITDA. And I would say that in terms of cash profits also, it would be somewhere in that range. If not, it probably would be closer to 55 to 60% of the overall operating cash flow that is generated. But that's only one reason. The other more important reason is, as they have gone along and the balance sheet size has grown, their credit rating has never wavered below probably some of the highest that any Indian corporate gets. So their ability therefore to raise debt at extremely competitive rates, because one is the credit rating, one is the size of the debt they are raising. I mean, this is a company that's on an average over the last decade invested close to 90 to 95,000 crore annually in terms of overall capex in this country. Last 3-year average would be closer to 1.4 trillion, 1,40,000 crore on an average. So and the philosophy that they have is that if I can raise this money at a cost of capital which is probably 300-400 basis point lower, if not more, than the cost of equity, then I have no problem. You can keep on arguing that my ROC probably doesn't look great because I'm doing capex and I'm raising debt, but the fact is I'm doing it at a cost which is so much competitive compared to my cost of equity, and I think that philosophy is also something that sort of I think flows through to the way that their capital allocation works. That people people like me have also asked them, why don't you return a little bit more money? Why don't you have a more aggressive dividend? They're like, we trust that we are investing money better than returning the money to the shareholders. We are creating more value by putting it in businesses that will eventually deliver much better return. So that is how how the philosophy works.
Yeah, and Reliance has a gigantic treasury operation as well, doesn't it?
Yeah.
And how has that? So is that another really important competitive advantage that? I mean, set aside all the technical abilities and scale and all that, they have an incredible financial engine within that that's powering all of this.
Absolutely. And I think, again, it comes down to sort of they have at any point of time, I think more than 1,20,000, 1,30,000 crore of cash in hand. Not net cash, because obviously there's debt, but that kind of liquidity is there in the system. And that obviously creates another income stream as well, which in itself would be a large business.
Correct.
If it was held outside Reliance. I think it's similar to, let's say, for example, Apple, if I can give an absolutely crazy example, but Apple's financial arm is today probably as big, if not more, than their core business, because that's the size of their cash reserves. Okay, they have a free cash flow, unlike what Reliance does, but with the kind of liquidity they have to play around with, the treasury operations also, are extremely significant in terms of creating income streams. The other income itself that they get, I think is a very, very big number compared to, let's say, any other corporate, because they can afford to have that, still have net debt at a manageable level and still meet all of their investment requirements while having that treasury leverage, in the markets.
And do we know exactly how much they've invested in, if I take the two bigger new businesses, which is Geo and retail, do we know exactly how much they've invested so far in those two businesses?
Yes, I think Geo would probably be, and it's a little bit, there is some investment in Spectrum and this thing, but close to, I think, $10-12 billion easily has gone into Geo. About $5 billion is something that they've invested in retail till date.
Yeah. And so again, coming back to the energy business, so there's everything that they've built so far, but there's obviously a lot of discussion about where this business goes in the future, especially if, as a lot of people say, there's going to be some sort of demerger where there's going to be standalone entities and this sort of energy business is going to be separate as far as the listed entities concerned from Geo, retail, etc.
Sure.
Where does this business go in the future? What does it look like 5, 10, 15, 20 years from now?
Wow. I wish I can give a coherent answer, but I think two things again here. One is what happens to the traditional business, and two, what happens to the additional new energy businesses that eventually, obviously, becomes part of your overall energy portfolio. So what they're attempting to do is one, the chairman mentioned this in his AGM a couple of years ago, is move away from traditional refined fuel, focus to move more and more into specialty chemicals.
Okay.
The way that the world is moving in terms of consumption patterns, demand for hydrocarbons is not going away. What is happening is demand for traditional transportation fuel is what is being challenged by the likes of EV and alternate fuels. So what I think Mr. Ambani is trying to do is to essentially say, okay, we're going to reduce in terms of, if you look at every barrel of crude that goes into my system, if today around 30 or 40% is still being sold in the form of refined products, I am going to ensure that even that sort of gets processed further into petrochemicals and specialty chemicals, which has a much more, I think, sticky demand even going forward, because you don't have an alternate manufacturing option for a toothpaste. You don't have an alternate for a tin, for a can, for a packet, for a packaging. You have environment friendly, but none of them have the scale to sort of compete with traditional petrochemicals, right? So the more you can actually move your facility towards chemicals from just if you think about what a barrel of crude does, a barrel of crude gets refined, produces petrol, diesel, LPG, naphtha. You take naphtha, LPG, you then further take it in and use this as input for your petrochemical process. That is very simply how a sort of oil to chemical process works. If you can therefore reduce what petrol and diesel you produce, if you can figure out a way where you can stream a barrel and directly convert it into chemicals, that is literally what oil to chemicals essentially sort of means. And in the Middle East there are some refineries where they have managed to sort of deliver petrochemicals directly without producing the refined products.
Is this SABIC and companies like that?
Yes, absolutely. SABIC is doing it, and in fact, what I was talking about HPCL, they are in fact trying to do that itself in Vizag, where they're saying we're not going to produce anything. 30% of every barrel of crude directly goes to petrochemicals. So I think Reliance, because obviously now for Reliance now, because they have a set system, they are very, very big player in refining. That graduation, that sort of transition will probably take a little bit of time. But that is the aim to do for the traditional business. The second thing that they're trying to do, of course, is with this whole new energy initiatives in terms of solar cells, in terms of green hydrogen, in terms of fuel cell. There also they want to do two things. One, they want to produce round the clock renewable power to again reduce the energy costs in the traditional fuel business or the traditional OTC business, and then the rest of it, of course, when they scale up to really the 100 gigawatt, that is the long-term aspiration, obviously then that business itself becomes several times larger than the current OTC business. I think that is where, I'm so sorry, I think that is where the sort of direction is in terms of the overall OTC business.
Specifically on this hydrogen business, so there's a lot of talk about hydrogen, there's green hydrogen, blue hydrogen, and all sorts of different types. Do you think that, based on what we know today, that this is actually a viable business? Okay, this is separate from Reliance. This is just generally speaking for whoever sort of decides to go down this path. What do you think the economics of that business look like? Are they materially different from the economics of sort of more traditional energy businesses? Do you think there's going to be a real first mover advantage? What are your thoughts on hydrogen as an energy business in general?
The economics is very simple. Today, with all the stuff that is going on, green hydrogen costs are still at somewhere, I think, around 5 to 6 rupees a kg. Okay. If you look at the production cost for green hydrogen, compared to that, a grey hydrogen, which is essentially hydrogen produced from your refining process, that costs a fraction of that. What green hydrogen needs to get to in order to be competing against every other comparable traditional energies, essentially get down to below 2 rupees a kg. That journey is basically what needs to happen, for which one, renewable power needs to continue to sort of really, really get cheaper. There need to be effective storage solutions so that you can have that round the clock power generation to fuel your green hydrogen production. And the green hydrogen production technology itself, there are the PEM technology is probably the most used today, But I think that is the stated aim of Reliance as well. When they got into it, I think they obviously had very clear aims of getting below 1.5 rupees a kg, dollars a kg. Sorry, for their green hydrogen business. But frankly, what we have seen over the last couple of years is that the momentum in green hydrogen seems to have slowed down a little bit. At least globally, what we see, the plans of sort of scaling up green hydrogen production, the kind of ambitious targets that people had, that seems to have been tempered a little bit. So my sense is you probably need more of an inflection point, the way the solar has gone, where today obviously solar energy costs are a fraction of traditional power costs. Yes, storage is still a challenge. Yes, round the clock power is still a challenge. But on the basic cost per unit, solar is probably comparable and better than, on a like for like basis than traditional energy sources. Hydrogen probably still needs a few years to get there, from what little I can understand.
Probal, I want to know, I have to ask this in the most blunt way possible. Do you think anyone will ever catch Reliance?
I think it depends. I think now there's not one Reliance. It depends which Reliance you want to catch. I certainly think that in terms of telecom, Bharti has done a good job. Again, with due apologies to Sanjesh, our star telecom analyst at ISEC. I don't want to tread on his toes, but from what we understand, after the initial shock, where Reliance just came in and frankly bludgeoned everyone with the pricing and data and rollout and everything else, the last couple of years, if you see, the subscriber growth, the movement in ARPU, the kind of, momentum that is there, I think Bharti has probably held its own. Retail, I think, frankly, I don't know if anybody has the capacity, frankly, to take on that kind of rollout of physical assets. Because what happens is that, one of the things that probably I didn't speak enough about is their ability to front end their capex and then sit back and say, okay, this is going to take me 6 years to monetize, that's fine. I'm going to wait it out. I have no problems. I'll front end my capex, which is exactly what they've done with retail. I mean, retail, they rolled out the infrastructure. It took time. But then what happened was Q1 of FY22, if I can get more specific, they had 30,000 crore of revenue. Today, they're at 90,000 crore plus. And the infrastructure for that was probably created over 2021 and 22. And that front ending is something that people have to sort of really contend with. And that requires a balance sheet strength, that requires a risk taking attitude, that requires that execution capability that they're known for. It's a combination of a whole lot of things that I don't know how many people can replicate. In energy, I think probably there are other players that have the similar ambitions. Even the OMCs, to their credit, I think are really, really getting aggressive in terms of their capital allocation to new energy, to increasing the complexity of their refineries to do better in more petrochemical conversion and so on. But whether they can sort of catch up, and because Reliance is also not going to stand still, so I think that advantage that they have will probably still be there. But I would say that the likes of Adani, for example, in renewable, have even more ambitious plans than Reliance does in some ways. So I think it's in energy, I would say probably there are players, but in terms of retail, in telecom, and in terms of the overall package that is there, at least I don't know if 10-15 years I have the wherewithal to make a forecast, but at least in the next 5 to 7 years, it's very difficult to see anybody coming close to their size and scale.
Yeah, absolutely. It is remarkable what they've achieved, and I don't know. It's sometimes I think about just the role Reliance plays in India's economy as a whole. Forget which business, all of that. It's just they've become so integral to just day-to-day life for all of us.
So I think I sorry to interrupt you. I saw a chart where we there was this wheel where Reliance is how many people Reliance is competing with at the same point of time, right? So they're competing with Paytm, they're competing with Star, they're competing with Z, they're competing with Aramco, they're competing with ONGC, they're competing with Bharti, they're competing with banks now, and so on. Every sector you talk about, you will have an example of somebody using a Reliance product.
Correct.
Or using a Reliance service or something else. So I think that is truly remarkable to be able to create and as I said at the beginning of the talk, 15% of merchandise exports of a country as big as India comes from one entity. I mean, that is a phenomenal stat in itself, if you think about it.
Absolutely. But Probal, thank you so much for taking the time.
My
This was
pleasure.
really fantastic. And thank you so much for talking so in depth and actually explaining all of this. And I think my biggest takeaway is how little I know actually of these businesses. And that's really the purpose of this, that to sort of dive deep into each of
See,
these
I-
individual businesses.
I'm an analyst. My job is to essentially either convince you or confuse you. So I don't know which one you are, but you know,
Maybe a bit of both.
there, job
No,
achieved.
but really, genuinely, it was really fantastic and really interesting. And thank you so
My
much
pleasure.
for taking the time.
Thank you for giving me the opportunity. Thank you for having me over. This was a very unique experience. So very, very interesting.
Thank you so much.
Good to
Thank
do
you.
this. Thanks.